Good morning, students. I am R. PUNNIYASEELAN, Assistant Professor, Department of Bank Management, St.Joseph College, Cuddalore. You know that all the companies or all the business must prepare and publish the final account at the end of the year. The final account comprises of three important documents. One is a profit and loss account, a balance sheet, and cash flow statement. Today I am going to give you a detailed view of cash flow statement, how to prepare a cash flow statement, and what procedure you have to follow while preparing the cash flow statements. See this. What is the cash flow statement? That is the word flow. The flow means changes. Cash flow means the changes in the cash balance. From the beginning of the year, there is a certain amount. That amount has been added or reduced, and at the end of the year, it will give the different balance. So, in between these two balances, opening and closing balance, many changes have been taken. So, we have to identify the change, reason for the changes. You have to identify all the changes between two period. That means two period means opening and closing balance. So you may see that the opening balance is a certain amount and the closing balance may be added. Say for example 7,000 in the opening and the closing it may be 18,000. So there may be some increase. And you may find that in the beginning you have 15,000 rupees and at the end you are getting 3,000 rupees. So there is a possibility. So there may be two chances. Increasing cash balance or decreasing cash balance, whatever it is the aim of the businessman to know how the changes are made, why the changes take place. So the increase and the decrease due to some transaction. So you have to identify all the transaction, and place it in the one statement. That statement is called cash flow statement. So cash flow statement means a statement which give the full description of transaction which are responsible for making changes in the cash balance between the two periods. And all the transactions, if you know that the transaction are responsible for making some changes, all these transactions are grouped into three categories. One is the transaction, the cash balance is changed due to operating activities. That means your business activities. When you are buying material, the cash is going out. When you sell the material, sell the product, you are getting cash inside. So because of your operation, you are paying salary, you are paying wages, you are paying electricity bill. So all the cash balance are going out. In the same way, some other, you are receiving interest, you are receiving dividend, and you are receiving some other income. So your cash is comes inside. So because of your business activity, the cash balance may be either increased or decreased. And then next, the transaction due to the activities take place in the asset side, particularly fixed assets. So when you buy the fixed assets, the cash is going out. When you sell the fixed assets, the cash is come inside. So these two transactions are responsible in relation with the fixed assets, and these are all making changes in the cash balance. So another one is financing activity, the transaction related with the liability side. So liability, that is a loan and creditors, whatever it is, fixed liability. So you are raising the further new loan, so your cash amount is coming inside, and you are repay the loan, then cash amount is going out. the balance will be changed. So there are all these transactions are grouped into three categories. So we need that identify the transaction related with the operation activity, the transaction related to asset activities, asset, and the transaction related to liability. All these are summarized up and given in one statement. So the cash flow statement means a statement which gives detailed list of transaction bringing changes in the balances. So, after identifying the transaction responsible for changes, you have to present in fixed format, in the format. So, three, accounting standard 3 is prescribed the format. So, you see that we start with cash from operating activities. It is started with a net profit, that is a closing balance of net profit, that is a current year profit. So with the current year profit, you have to add non-cash expenditure. What is the meaning of non-cash expenditure? The expenditure which require the cash movement is called cash expenditure. For example, salary. When the salary is recorded, the amount of cash, equivalent amount of cash is going out in the hands of employee. But when you record the depreciation, it is recorded as expenses, but there is no movement of cash. The cash is kept in the business itself. When you record the loss as expenses, it is not given to someone else. It is in the hands of a business. So all these transactions are called non-cash expenditure. You have to add it back all the non-cash expenditure to know the cash balance. In the same way, non-cash income. When you receive the cash, when you receive the profit, it is entered in the cash book already. So you need not keep the profit amount as a new cash item. So that's why we have to remove or reduce the profit earned from the net profit. Then when you are adjusting these two things, that amount will be some certain amount will be arrived. That amount is called fund from operation. Due to your business activity, certain amount of fund is generated. Then there are some assets in the balance sheet. We have four type of assets. I will give you in detail. And then basically some assets are fixed. The fixed means we are using the assets for long term purpose. So the current assets means it is converted into cash within the 1 year. So we take the changes in the current assets, the changes in the current liability, and and it should be added in the business activities, that is operating activities. If the current asset is increased, that means purchase, the cash is going out. So it should be decreased. In case of current assets is decreased means sold. So when the current assets are sold, cash is coming inside, so it should be increase the cash balance, so it must be added. In the same way, current liabilities are decreased, it means the cash is decreased means we repaid the liability, so it should be reduce the cash balance, so it should be reduced from the fund from operation. And another one is the current liability is increased means we are receiving the new credit, so that will increase the cash balance, it should be added. So after giving these changes in the current assets with fund from operation, then amount arrived now is called cash from operation, that is a total cash from your business activities. So from this you deduct income tax, that amount what is arrived, that should be taken to net cash flow from the operating activities in the separate form. So next column. Then next see this. So already I told you there are three type of transaction. One is operation related transaction, another one is investment related transaction. It is purely related with the fixed assets. If you buy the fixed assets, the cash is going out, it is put in the minus sign and within the bracket, and the sale of assets which will bring the cash inside, so it should be positive balance, so it should be shown in the balance. After adjusting, there are several, I put here only two. There are several assets, building, machinery, furniture, whatever it is. All these changes are to be recorded, and the final things, final adjustment. After adjusting the cash outflow and the inflow, the net cash flow is is added with interest and dividend. That should be shown in the taken to next column. That is a net cash flow from the investment activities. And another transaction responsible for making changes in the cash balance is financing activity. It is related with finance. So when you raise a loan, so the cash is coming inside, positive balance. When you issue shares, when you issue debenture, you are getting cash, so that should be positive balance added. When you repay the loan, so cash is going out, so our balance is decreased, so it is put in the bracket, and all these are adjusted. Then the final from the final amount, you have to deduct the interest and the dividend paid. Then you take the remaining balance to outer column, that is the net cash flow. See, now we identify all the three transactions, three type of transaction, and given in the statement. Now you have to add all the net cash flow, find out the net cash flow from all the activities A, B, C. So you add all the things, it will be, sometimes it may be positive, sometimes it may be negative, whatever it is. From the net cash balance, with the net cash balance, you add opening cash and bank balance. So the opening cash and bank balance will be added. Then it will give the amount. That amount is equivalent to closing cash balance. Closing cash balance is shown in the balance sheet. So when the both figures are same, so you are preparing the cash flow statement in correct view. So this is the format of cash flow statement. Then, so here you, after seeing the cash flow statement, you know that cash flow is due to three activities. All the activities are appeared in the two document, that is the profit and loss account and balance sheet. Operating activities transaction are appeared in the P&L account. You must know where to know that is a cash account, cash expenses, non-cash expenses can be identified in the P&L account. See that bold color expenses are non-cash expenditure. That is another one is rent, salary, tax, insurance, discount, everything cash is taking from the company. And depreciation, preliminary expenses, goodwill written off, reserve, provision for doubtful debts, income tax provision, proposed dividend, loss on sale of assets, all these are non-cash expenditure. They are shown in the P&L account as a expenditure, but they did not take a cash from the company. So all the cash or the equivalent cash amount is kept in the company side. So the same way, in credit side, the profit on sale of asset, income tax refund, profit on investment, rent received, dividend received, these are all the profit item. But when you receiving the profits, it is entered in the cash book, so you need not add back. So that's why it is deducted. So when you go through the profit and loss account, you may identify non-cash expenditure and cash expenditure. So under studying, analyzing the profit and loss account, give you some details relating to operating activities. Then you have to study the balance sheet. Well, so the asset side, balance sheet has two sides. One is a liability side and asset side. The asset side has assets. All are classified into four categories. One is a fixed assets, another is fixed assets intangible, and current assets and fictitious assets. The same way, all the liabilities are classified into five categories. Share capital, that is a owner fund, retained earning and reserve. These two are owner fund, and long-term liability, that is a fixed liability, current liability, and provisions. See that balance sheet. See, fixed assets, tangible, machinery, plant, furniture, building. So understanding these things will help you to identify the transaction which are responsible for making changes. Then you have to see that the balance sheet is classified into category. Then when you when you want to know what transactions are making changes from the asset side, you must have the blank. You must understand what type of transaction and nature of transaction take place in the fixed assets. In case of fixed assets, tangible fixed assets means building, machinery, whatever it is, you can see and touch and everything. You see that there are five transactions will be take place during 1 year. So it starts with opening balance. Sometimes you can purchase the fixed assets, and you are using the fixed assets for which you are charging depreciation, and end of the year or during the year, if you are if the asset is not fit to your purpose, then you sell it. That is sales. When you made your sales, it may be made on profit or it may be made at a loss. Whatever it is, it should be recorded. So here cash purchase, and then depreciation, that is red colored items are related with operating activities. All these are non-cash expenditure. These should be taken to operating activities. The cash purchase and the cash sales, that should be investment activity, taken to investment activities. Then go to the fixed assets, tangible, intangible. Here only one transaction takes place during 1 year. So start with opening balance and closing balance. Here the opening balance is reduced because the intangible assets are charged every year proportionately, and it should be come to nil. So that's why the amount rate of during the year is taken to P&L account. The P&L account is related with operating activities, take it to operating activities. Then current assets, all the current assets are adjusted in operating activities, that's why it is not given here. And then fictitious assets, the assets which is in the form of expenditure but no value, market value, that type of assets are fictitious assets. Preliminary expenses, advertisement campaign, P&L account loss, all these are given. So these assets are written off, just like intangible assets, it is written off every year, reduced every year. So that is the portion of amount reduced in the reduced must be charged in the P&L account. So it is a P&L account transaction. So you take it to operating activities. Then go to the share capital. So it start with opening balance and having closing balance. It is common, but in during the year the shares may be further issued. So if you issued, it is a cash come inside. So that should be entered in the credit side. And suppose the company or owner wants to repay the buy the shares in the market, then you have to apply the cash. This is cash. So here by cash, two cash are there. So these cash items are taken to financing activity because it is related with the liability. If any cash transaction related with financing activity, that is a liability activity, that will be taken to finance. Any cash and cash transaction related with asset, that should be taken to investment activity. It should be very clear and you have to keep it in mind. Then general reserve. During the 1 year, only one transaction. Already some balance are there. Some balance is added. Some amount is added with the balance as a reserve. So it should be charged P&L account. Then it is a operating activity, taken to operating activity. And then long-term liability. The opening balance are there. Further loan may be arised during the year, and sometimes you may repay the amount during the year. That should be nature. That should be cancelled. That should be considered. All the cash item must be taken to financing activities. Then current liability. Already I told you that current assets and the current liabilities are directly adjusted in the operating activities. Any changes in current liability, that should be adjusted in the operating activities. That's why it is not given here. And then provision and dividend. All these the provision and the dividend, only two transactions take place during the year. It start with opening balance, then the new provision for the current year is added, and sometimes it should be paid, dividend may be paid, tax may be paid, you apply. Here there is a cash transaction in the debit side. The debit side is taken to financing activity. There is a P&L account in the credit side, it should be taken to operating activities. So you know that these are common things. Cash transactions are taken to investment or financing activities, depends on fixed assets and liabilities. The P&L item, whether in the liability side or whether in the asset side, it should be taken to operating activities. So with this information, now you can understand how to prepare a cash flow statement. So I hope everyone understand this, the preparation of cash flow statement in details. We will see in the next session how to solve the problems of in the cash flow and preparing the cash flow statement. Thank you to one and all.